Qualcomm is one of the companies leading the huge tech boom we are currently experiencing, creating semiconductors, software and services related to wireless technology. And over the past 6 months, it is down by 23%. And so in today's video, I will figure out if this drop in price is justified or if right now it's a great opportunity to buy Qualcomm at a discount price. So right away, jumping to our stock valuation spreadsheets, we can see that Qualcomm has a dividend yield of 2.12% with a low trailing free cash flow payout ratio of only 35.79%, which means that after paying out a dividend, they still have enough free cash flow to push into innovation, which is extremely important for companies, specifically in the technology sector. Now moving straight to the 9-pillar analysis, we can see that they get a rating of 9 out of 9. Now first let's have a look at their growth. We can see that their revenue has been growing at a rate of 12.83% yearly over the past 5 years on average. They have been increasing their free cash flow at a rate of 33% yearly and increasing their net income at a rate of 28.29% yearly. So some great growth in the profit sector, and something I love about Qualcomm is that their free cash flow and their free cash flow growth is higher than their net income growth. So if we have a look closer, we can see that indeed in 2023 the net income was sitting at 10.1 billion while the free cash flow was sitting at 11.1 billion. And the reason why I love the free cash flow to be higher is that while the net income is just a measuring metric, the free cash flow is the actual sum of the money that flows through the company and can be used for various things such as innovation or share buybacks. Now looking back to the 9-pillar analysis, we can see that Qualcomm has been decreasing their shares outstanding at a rate of 0.33%, which is nice. Their profit margin is sitting at almost 60%, which is as well great. And their long-term liabilities over the 5-year free cash flow negative dividends is sitting at only 0.45, which means that they won't have an issue with paying off their long-term liabilities with the free cash flow they currently generate. Now something I again love with Qualcomm is their low 5-year PE ratio sitting at only 14.77, which means that investors are underpaying for the company's earnings, paying only $14.77 for every dollar of Qualcomm's earnings. And that is the same case with the price to free cash flow, which is sitting at only 14.81. Again, investors are underpaying for the company's free cash flow. And finally, let's have a look at the company's consecutive dividend growth, sitting at 5.42%. And if we have a closer look, we can see that indeed Qualcomm has been increasing their dividends very steadily over the past 5 years. We can see that on the graph below as well. And now finally, let's calculate Qualcomm's intrinsic value, first using the Graham's formula revised. And here we plug in the 5-year earnings growth estimate at 17% yearly over the next 5 years and get an intrinsic value of $286.62. Now for the next valuation model, we have a look at the free cash flow of the company. We plug in a future growth rate of 13.7% for the next 10 years plus, a discount rate at 11% and get an intrinsic value of $287.67. Now for the third valuation model, we compare Qualcomm to 3 of its competitors and get an intrinsic value of $241.60. Now heading to the final valuation model where we look at the dividends of Qualcomm. We project a growth rate of 7.67% into the future and get an intrinsic value of only $104.69. And finally, averaging out the 4 valuation models, we get an ultimate intrinsic value of $230.40, which is about 43% higher than the current trading price of the company. And with a margin of safety of 30%, we get an acceptable buy price at $161.10. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe as it really helps me out.